Okay, picture this. What if you could actually decode the seeming chaos of financial markets? Could there be a hidden language in those charts, something that, whispers about where prices might go next? Welcome to the deep dive. Today, we're really getting into it, the fascinating world of technical analysis. We're using a really comprehensive source, the technical analysis of financial markets. Our mission here is simple. Extract the core insights, cut through the noise, and give you a solid foundation in how pros analyze price, volume, patterns, basically how they make informed decisions. Get ready for maybe some surprising facts and definitely some aha moments as we explore this stuff. So right off the bat, I'm wondering, is there really a philosophy behind just looking at charts? Or is it like pure science?
That's a great starting point. And, related to that, how can historical price movements truly predict future trends? Is it more art or science? That's a huge debate.
Yeah, and what makes one chart type better than another, like for different situations?
Exactly. And importantly, why do some people argue that technical analysis is no better than a random walk? We'll definitely unpack that controversial idea right here.
Okay, let's start with the basics then. What exactly is technical analysis, and how does our source differentiate it from, say, fundamental analysis? Because they often get mixed up, right?
They do. It's a crucial distinction. So the source defines technical analysis as the study of market action itself. We're talking primarily about price movement, trading volume, and also open interest, especially in futures. It's less about a company's balance sheet, its intrinsic value, and more about understanding the market psychology, recognizing patterns that emerge from how people are actually trading.
Ah, okay. So the psychology.
Right. And here's a key insight the book highlights.
Yeah.
Technical analysis focuses on when to buy or sell. Fundamental analysis. That's more about what to buy or sell based on that intrinsic value idea, the timing versus the selection.
Got it. So the when is the technical side. And the book really emphasizes the importance of timing, doesn't it? Especially for things like futures contracts that move fast.
It really hammers that home. The idea is, even if fundamental analysis helps you pick a great stock, for instance, technical analysis tells you the optimal moment to act. Get the timing wrong, and, you could miss the move or get a bad entry.
Makes sense. You don't want to jump in too early or too late.
Precisely. And another thing the source really delves into is the flexibility and depth of technical analysis. It shows how these principles aren't just for stocks or just for short-term trading. You can apply them across different markets, futures, currencies, you name it, and on various time frames too, from minutes and hours up to weeks, months, even years. That versatility is, I think, a really key takeaway.
Okay, but let's tackle the big criticism. I know the random walk theory comes up, this idea that price movements are basically random, unpredictable. How does technical analysis, which is all about finding patterns, stand up to that?
Yeah, that's a fundamental challenge. And the book addresses it head on in a section called Some Criticisms of Technical Analysis Theory, specifically mentioning the random walk theory.
Okay.
So the skeptics argue, look, past movements have zero predictive power. It's all random. But technical analysts believe patterns do repeat. Why?
Because people repeat.
Essentially, yes. Because of consistent human psychology. Fear, greed, the herd instinct. These things create observable structures and patterns in market behavior. It's not about perfect prediction, more about recognizing these recurring footprints. It's probabilistic, not deterministic.
Okay, footprints. I like that analogy. So if we're talking history, we absolutely have to talk about Dow Theory. It feels like the grandfather of all this. What are its core ideas?
It really is the foundation. Charles Dow back in 1882. The source dedicates a whole chapter to Dow Theory. And one of his basic rules is this idea that market averages or indicators must confirm each other.
Confirm each other? How so?
Well, the classic example is the Dow Jones Industrial Average and the Dow Jones Transportation Average. If the industrials are hitting new highs, Dow Theory says you want to see the transports doing something similar to confirm the strength of the overall market trend, like getting a second opinion.
Ah, okay. Like two witnesses agreeing on the story. And Dow Theory also gave us the idea of different trend types, right?
Yes, exactly. A central concept is recognizing three types of trends. There's the major trend, think of it like the main tide, lasting months or years. Then you have the intermediate trend, which is like waves on that tide, lasting weeks to months. These are corrections or rallies within the major trend. And finally, the minor trend, the ripples on the waves, lasting days to maybe a few weeks, just short-term fluctuations.
That's interesting. So this raises an important question for you listening. How do you actually reconcile these different trend durations in your own analysis, without getting caught up in just the daily noise?
That's a key challenge for anyone learning this. Understanding that hierarchy, tide, wave, ripple is crucial for perspective.
And volume. Volume plays a big part in Dow theory too, doesn't it?
Absolutely. The source highlights the importance of treating volume. The basic idea is that volume should confirm the trend.
Meaning.
Meaning, if prices are rising, you ideally want to see volume increasing too. It shows growing participation, conviction behind the move. If prices are rising but volume is drying up, that's often a warning sign.
A red flag, suggesting the trend might be losing steam.
Exactly. It suggests underlying weakness. Now, the book does mention some criticisms of Dow theory and talks about new ways to use Dow indicators for modern markets. But those core principles, confirmation, trend structure, volume, they're still incredibly relevant. It's the bedrock.
Okay, let's shift from theory to visuals. Charts. What kinds are we talking about, and why choose one over another?
Right, the actual tools. The source, in structure of charting, details the main types of charts. You've got the simple line chart, which just connects closing prices, good for a clean overview. Then there's the bar chart. This one gives you more info for each period, the open, high, low, and close prices. So a fuller picture of the trading range.
And candlesticks. Those seem really popular.
Very popular. Candlesticks are visually rich. The body shows the open and close, the wicks show the high and low. Many traders find them really intuitive because the color and shape immediately tell you something about the battle between buyers and sellers during that period. They kind of tell a story at a glance.
Makes sense. And it's not just the price on the chart, is it? You mentioned volume earlier and also open interest. Why are those important?
They add context and depth. Trading volume, as we said, shows the intensity behind a move. High volume can confirm a breakout, for example. Open interest is mostly relevant for futures and options. It measures the total number of outstanding contracts that haven't been settled. If price and open interest are both rising, it often signals new money flowing in, strengthening the trend.
So, more conviction.
Potentially, yes. It adds another layer to the analysis. The book even points out a practical detail, the delay in recording futures volume and open interest. So you need to be aware that the data might not be perfectly real-time, a small but important point.
Good to know. Now, something that sounds a bit technical, but the book stresses it. Arithmetic versus logarithmic scale. Why does this matter?
It matters a lot, especially for looking at charts over long periods. An arithmetic scale shows equal spacing for equal point moves. So a $10 move looks the same whether the price goes from $10 to $20 or from $100 to $110.
But percentage-wise, those are hugely different moves.
Exactly. The first is a 100% gain. The second is only 10%. A logarithmic scale, on the other hand, shows equal spacing for equal percentage moves. So it gives you a much truer picture of long-term trends and growth rates. For analyzing decades of market data, it's pretty essential.
Okay, that's a crucial distinction for long-term perspective. So let's talk about identifying trends. What defines a price trend according to the source?
Basically, a price trend is defined by its structure. An uptrend is a series of successively higher peaks and higher troughs. Think higher highs and higher lows. A downtrend is the opposite, a series of lower peaks and lower troughs, lower highs and lower lows. Recognizing this basic structure is, well, fundamental to trend analysis.
And within those trends, we find support and resistance. These terms come up all the time. What are they really?
They really are like battlegrounds, as the source suggests. Support is a price level where buying interest is typically strong enough to overcome selling pressure, causing a decline to halt or reverse. It's like a floor. Resistance is the opposite of price level, where selling pressure overcomes buying pressure, stopping in advance. It acts like a ceiling.
And these levels aren't fixed forever, right?
Not at all. And that's a critical concept, how support and resistance roles reverse. When a resistance level is decisively broken, it often becomes a new support level. And when support breaks, it can turn into new resistance.
Why does that happen?
It ties into the psychology of support and resistance. Once a level is broken, perceptions change. People who sold at the old resistance might now buy dips back to that same level, seeing it as a new floor. It's about how market participants remember and react to these key price points.
That's fascinating.
Yeah.
And the book even mentions psychological numbers, like round numbers.
Yes, the importance of psychological numbers. Think 10, 50, 100, 1,000. These often act as informal support or resistance, simply because people tend to anchor to them. They place orders around these levels. It's a subtle but real phenomenon.
So what does this all mean for you, the listener? If you can spot these levels and lines, it seems like a powerful tool. How do we build on that?
It absolutely is. The next step is using trend lines. You draw these by connecting two or more significant lows in an uptrend, or two or more significant highs in a downtrend. They help visualize the trend and can signal potential breaks. The source also introduces a more advanced idea, the fan principle. This involves drawing three trend lines fanning out from a major peak or trough. When the third line is broken, it's often considered a significant signal of a trend reversal, kind of like three strikes and you're out.
Okay, from lines to shapes, let's talk patterns. What are the common chart patterns analysts look for? Are they like signals?
They are definitely treated as signals. The source covers both price reversal patterns, those that suggest a trend is ending, and continuation price patterns, which suggest the trend is just pausing before resuming.
Okay, give me some examples. Reversal patterns.
The classic reversal patterns are things like the head and shoulders top or bottom, and double tops and bottoms, or triple tops bottoms. Seeing these form after a sustained move often signals a potential change in direction.
And continuation patterns.
Those are things like triangles, symmetrical, ascending, descending, flags, and pennants. These usually form mid-trend, representing periods of consolidation before the market continues in its original direction.
And volume is important here too, I assume.
Very important. The book stresses the importance of trading volume when interpreting patterns. For instance, a breakout from a pattern on high volume is generally seen as more reliable than one on low volume. It adds conviction. The source even gets into nuances like spotting invalid head and shoulders patterns, showing it's not just about recognizing the shape, but understanding the context.
Right, it takes some skill. Now, beyond just looking at price and patterns, what about mathematical tools, indicators and oscillators, like moving averages?
Yes, the source goes into momentum indicators in detail. Moving averages are a big one. They smooth out price data to make it easier to see the underlying trend. There are different types: simple, weighted, exponential. The book covers various versions like simple, linear weighted, and compound. It discusses how traders use them, like looking for crossovers between a short-term average, like a 4-day, and a longer-term one, like an 18-day, as buy or sell signals.
And moving envelopes, is that like Bollinger Bands?
Essentially, yes. Moving envelopes or bands plotted above and below a moving average. They help gauge volatility and identify times when the price might be stretched too far from its average, potentially signaling a reversal is due.
Okay, and what about oscillators? How are they different?
Oscillators are tools that tend to fluctuate above and below a center line or between set levels. The book covers key ones like the Relative Strength Index, RSI, the Rate of Change, ROC, and the Stochastic Oscillator. Their main job is often to identify overbought or oversold conditions.
Meaning the price has moved too far too fast.
Exactly. For instance, the RSI typically ranges from 0 to 100. As the source details, readings above 70 are often considered overbought, potential sell signal, and readings below 30 are considered oversold, potential buy signal. They provide warnings that a trend might be exhausted.
So this raises another important question for you listening. If these indicators are so widely used and the signals seem clear, buy below 30, sell above 70, why isn't everyone making easy money just following them?
That's the million-dollar question, isn't it? It highlights that these tools aren't foolproof crystal balls. They give signals, yes, but those signals need interpretation within the broader market context. They can give false signals, especially in strong trending markets. It's about using them as part of a larger toolkit, not in isolation.
Right, context is key. Okay, let's zoom out. Does technical analysis only work for short-term stuff, or can you apply it to the really big picture?
Oh, absolutely. The source really emphasizes the importance of longer view. It has whole chapters on long-term charts and time cycles. It shows how technical principles apply just as much to weekly or monthly charts looking back decades. It even touches on concepts like the long-term Kondrativ wave economic cycle and various seasonal cycles that might influence markets. The idea is that markets might have longer-term rhythms.
Rhythms. That's interesting. And what about intermarket analysis, connecting different markets?
This is a really fascinating area. Intermarket analysis looks at the relationships between different asset classes. Our source explores, for example, the relationship between bonds and stocks, or between bonds and commodities, and even how the U.S. dollar and market prices interact.
So like how strength in the dollar might affect gold prices.
It's exactly that kind of thing. Understanding these connections gives you a more holistic view. Weakness in bonds might signal future trouble for stocks, or rising commodity prices might impact inflation and interest rates. It's about seeing the bigger financial ecosystem.
Okay, we've covered a ton of analytical tools, but knowing this stuff is one thing, using it effectively and safely is another. What does the book say about actual trading and managing risk?
This is absolutely crucial. The chapter on money management and trading tools is key. It highlights 3 elements necessary for successful trading, and a huge part of that is risk control. It really underscores the critical importance of using stop loss and profit-taking points, setting predefined exit points for both losing trades, stop losses, and winning trades, profit targets. This isn't just a suggestion. The book presents it as fundamental for survival.
Protecting your capital.
Protecting your capital and managing your emotions. Knowing your exit points beforehand helps avoid impulsive decisions in the heat of the moment.
So it's not just finding the signal, but having a plan for how you'll act on it, win or lose.
Precisely. And the source also touches on the idea of developing general trading systems. It gives practical advice on the vital need to test a trading system or build your own. Backtesting your ideas against historical data is the best way to see if they actually have merit before risking real money.
Right. Verify before you trust.
Exactly. Rely on data, not just gut feelings.
Wow. Well, that was certainly a deep dive into technical analysis. We've gone from the core philosophy, the foundational Dow theory, all the way through charts, trends, patterns, indicators, oscillators. Quite the journey.
It really was. And we managed to touch on the bigger picture, too, with those long-term cycles and intermarket relationships, and importantly, wrapped up with the absolute necessity of money management and discipline.
So after all that, what's one final, maybe provocative thought for our listeners to chew on?
Okay, here's something to think about. The source implicitly suggests that even though technology has massively changed how we do technical analysis, computers, algorithms, the core principles haven't really changed that much because they're rooted in human psychology and market behavior, which remain pretty consistent. So this raises an important question for you. In a world where AI and automated trading are becoming more and more dominant, will that human element of technical analysis, the part that focuses on patterns born from our collective psychology, will it keep its predictive edge? Or will the machines eventually figure it all out?
That's a great question. Food for thought. What stood out most to you from today's discussion? Let us know in the comments. And hey, if there's a specific market topic or really any topic you want us to tackle in a future deep dive, tell us below.
And don't forget to check the description. We put links there, including one to the source book we discussed today. If you want to go deeper into these concepts, we really recommend checking it out.
Yeah, definitely. And we touched on things like trading strategies and specific indicators today, topics we've actually covered in more detail in some of our previous deep dives, so feel free to browse our back catalog. And of course, if you found this deep dive valuable, please hit that subscribe button. It helps us keep bringing you these insights. Again, all the links, including the source, are in the description.
Join us next time as we continue unpacking complex subjects. We've got some more really interesting deep dives planned, so stay tuned.